Let me describe two people to you. Same city, same age, both 34, same income, same apartment complex, one floor apart. They passed each other in the parking lot every morning, both drinking the same too expensive coffee, both watching the market wobble in early 2020 thinking this is probably fine. It was not fine. The market dropped 34% in 33 days. Here's where their stories split. Person A had no emergency fund, $11,000 in credit card debt, and a 401k that was 90% tech stocks. He got furloughed, panic sold everything, locked in a $40,000 loss, and never went back. He's $180,000 behind where he'd be if he'd done nothing. Person B kept contributing through the crash, used the drop to do a Roth conversion, came out with more shares at lower prices. The crash didn't create that gap. Everything they did in the months before it hit did. My name is Nick, and I've spent way too much time studying why some people build wealth through crashes while others get destroyed. That's what we're covering today. Before we get into what to do, let's make sure we're all looking at the same market, because right now, the warning signs are louder than they've been in a very long time. And I want to explain why without making you feel like the world is ending, because it isn't. Here's where we actually stand. The Shiller-Cape ratio, one of the best long-term valuation measures we have, is currently in the high 30s. The long-term average is around 17. We are still well above historical norms. The last time we saw levels like this was during the dot-com era in the early 2000s. Right before the Nasdaq lost nearly 80% of its value and the S&P 500 spent years recovering. Great company, great timing. On top of that, the top 10 stocks in the S&P 500 now make up roughly 30% to 35% of the entire index, depending on the exact date. 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, account for roughly a quarter to around 30% of the index today. During the dot-com peak, that concentration was closer to 23%. We've moved well beyond that level, and in 2022, those same large cap tech names fell sharply, while the broader S&P 500 declined less, showing how concentration can distort what diversification really means. The index looks diversified. It isn't. Then there's the geopolitical volatility in the Middle East and the Strait of Hormuz, the narrow channel that carries roughly 20% to 25% of global seaborne oil shipments. With energy prices remaining volatile, core inflation still stubbornly above central bank targets, and major banks keeping recession probabilities elevated, the red flags are everywhere. Consumer confidence is currently weak by historical standards. While declines in confidence have often occurred before recessions, there is no fixed threshold like 80 that reliably predicts economic downturns. And then there's Warren Buffett, with Berkshire Hathaway holding hundreds of billions in cash and short-term US Treasury bills. He's been a net seller of stocks in recent periods. Berkshire Hathaway is currently outperforming the broader market, and he isn't doing this because he's afraid of missing upside. He's doing it because he's done the math. Now, and this is important, none of that means a crash is definitely coming or that you should sell everything. What it means is that the conditions that have preceded every major market correction in modern history are currently present. And if you haven't done the 5 things we're about to cover, you are person A in that opening story. Not because you did something wrong, because nobody ever sat you down and explained how this actually works. Let me introduce you to a couple we'll call Arkin and Via. He's in project management making $58,000. She's in healthcare admin at $54,000. Combined household income, $112,000. That puts them in the top 30% of American households. They should be building something. Instead, they have $4,200 in savings, $14,000 in credit card debt at 21% APR, a 401k that Arkin hasn't looked at since he enrolled, sitting in the default fund, 65% concentrated in US large cap growth stocks. They have no idea. When COVID hit in February 2020, Arkin got furloughed for 6 weeks. The market dropped 34%. Their savings ran out in 3 weeks. They started pulling from Arkin's 401k, which triggered a 10% early withdrawal penalty on top of ordinary income tax, meaning they lost roughly 30 cents of every dollar before they even saw it. They sold the rest in mid-March, right at the bottom, because the news was terrifying.